Hello students. The last session under technical accounting, you have studied about the Tally ERP. You have done from entry to finalization. Now one of the aspect in accounting is recording of the taxes and accounting of the taxes. And one of the important tax is indirect tax, which is called as a goods and services tax. Now from this session student, we are going to introduce to you the basics of goods and services tax, that is GST. Myself Professor Shreya Vaidya is going to introduce to you the GST. Now before that, let us have some comparison between the direct taxes and indirect taxes. In direct taxes, the payer of tax and the sufferer of tax one and the same, that is impact and incidence on the same person. While in indirect taxes, payer of tax is not the sufferer of tax, whereas the sufferer of tax is not paying directly to the government. That is the impact on one head and incidence of tax on the other head. Direct tax are income based or wealth based taxes, while the indirect taxes are based on the supply of goods and services. Rate of taxes under direct taxes are different from person to person, while rate of duties are not different from person to person in indirect taxes. In direct taxes, the entire revenue goes to the central government of India, while under the indirect taxes, it is a revenue source to the central government as well as the state government. Previous year income assessed in the assessment year in the case of direct taxes. Well, there is no previous year and assessment year concept in indirect taxes. Now, the highest authority is CBDT, which is called as Central Board of Direct Taxes. While for indirect taxes, previously it is CBEC, that is Central Board of Excise and Custom. Now that will renamed as Central Board of Indirect Taxes and Custom, that is CBIC. Direct taxes are progressive in nature, while the indirect taxes are regressive in nature. Now example of direct taxes are income tax as well as wealth tax, expenditure tax. Indirect taxes are GST, which is goods and services tax, as well as the custom. Now basically what is GST? Goods and service tax is a tax which is levied on goods and services imposed at each point of sale or rendering of services. GST could be on entire goods or services, or there could be some exempted class of goods or services or a negative list of goods and services on which GST is not levied. GST is an indirect tax in the lieu of tax on goods, that is a excise, and tax on services, that is a service tax. The GST is just like a state level VAT, that is value added tax, which is levied as a tax on sale of goods. Now one interesting fact is that France was the first country to implement GST in the year 1954. Presently, about 160 countries across the world have adopted the GST, with Canada as a dual GST model just like India. The central government of India on 1st July 2017 as the date from which much awaited indirect tax reform, that is goods and services tax. Accordingly, the GST have been implemented in India with effect from 1st July 2017. The GST will extend to whole of India, including the state of Jammu and Kashmir. On 7th July 2017, the Jammu and Kashmir Goods and Services Tax Bill 2017 was passed by the state legislature, empowering the state to levy the state GST on intra-state supplies with effect from 8th July 2017. Now we'll talk about some features or advantages of GST. The GST is a value added tax. That is a tax levied at a multiple stage of production and distribution of goods and services, in which tax paid on input are allowed as a set-off against the tax payable on output. In short, we can say that GST charge on the value addition. It is a chain of tax credit. See, GST offers comprehensive and continuous chain of tax credit from the producer's point or services up to the retailer's level or consumer's level. The burden of GST is on final consumer. That is, the final burden of GST is borne by the consumer as it is charged by the last supplier with the set of benefits at all previous stages. There is no cascading effect of taxes. Student, this is the most important benefit we are getting from the GST. The past tax structure in India has number of indirect taxes collected by central as well as state government. Due to such multiple taxes, there had been a cascading effect, that is a tax on tax and double taxation. So GST removed that. Now GST will subsum all these indirect taxes and thus facilitates a seamless flow of credit, resolving the problem of double taxation, or you can say cascading effect of taxes. Now under central taxes, we subsum the central excise, additional duties of custom, we call it as a CVD, special additional duty of custom, that is SACD, service tax, central sales tax, as well as the central surcharges and cess so far as they are related to supply of goods and services. While under the state taxes, we are going to have a VAT, luxury tax, entry tax, but remember, not a lieu of octroi, entertainment and amusement tax, taxes on advertisement, purchase tax, taxes on betting, lotteries, gambling, state surcharge and cess so far as they are related to the supply of goods and services. Now, what is the framework of GST in India? We will talk about the framework of GST in India. A dual GST will be in keeping with the constitutional requirement of a fiscal federalism. GST in India will be the dual model based on state and central government. They will both levy GST in term of SGST or UTGST and CGST respectively. Central Goods and Services Tax Act 2017, that is CGST. CGST levied and collected by the central government. It is a revenue source to the central government of India, that is on intrastate supplies of taxable goods or services or both. So this is what a CGST, that is Central Goods Services Tax Act 2017. Now next is State Goods Services Tax Act 2017. We call it as a SGST. It is levied and collected by the state government or union territories with the state legislature, namely Delhi and Pondicherry, on intrastate supplies of taxable goods or services or both. It is a revenue source of a respective state government. Now come to the UTGST, that is Union Territory Goods and Services Tax. It is levied and collected by the union territories without state legislature on intrastate supplies of goods and services. Note that India is a union of states. The territory of India comprises of the territories of states and union. Currently, there are 28 states and 8 union territories. Out of that, 3, that is Delhi, Pondicherry and Jammu and Kashmir, are having a state legislature. While in union territories without state legislature, that is central GST will apply to whole of India, and hence it would be applicable to all union territories with or without legislature. Now there are 5 union territories which are without legislature, that is Lakshadweep, Daman, Diu, Dadra, Nagar Haveli, Andaman Nicobar Island, Ladakh and Chandigarh. Now what is the basic definition of union territory? The definition of union territory has been amended with effect from 30 June 2020 under the section of 2114 of CGST Act 2017. Union territory of Dadra Nagar Haveli and Union territory of Daman and Diu have been merged in one single union territory with effect from 26 January 2020. Ladakh has been the union territory with effect from 31st October 2019. Now IGST. IGST is a mechanism to monitor the intra-state trade of goods and services and ensure that SGST component accrues to the consumer state. It would be maintain the integrity of input tax credit chain in interstate supply. The IGST rate would be broadly be equal to CGST rate plus SGST rate. IGST would be levied and collected by central government on all interstate transaction of taxable goods and services. Now we will come about the interstate transfer. Students, we have heard intra, inter. So what is interstate transfer? Under the section 7 of IGST Act 2017, supply of goods and services shall be treated as an interstate supply where the location of the supplier and the place of supply are in two different states or in two different union territories or a state and a union territory integrated goods and service tax, that is IGST, shall be charged on an interstate transfer. Let's have the example. See, in the first case, the place of supply is Maharashtra, while the place of supplier is Gujarat. So it is an interstate transfer. So IGST is a charge. In the second stage, the place of supply is Punjab and the place of supplier is Chandigarh. Now student, Chandigarh is located within the state of Punjab, but Chandigarh is a union territory and hence it is not considered as an intra-state supply, it is considered as an interstate supply. So according to the section 7 of IGST Act 2017, when the place of supply is Punjab and the place of supply is Chandigarh, we have to apply the IGST. Now apart from that, if there is an import of goods or services into the territory of India, it will be treated as a supply of goods and services or both in the course of interstate trade. And accordingly, the IGST will be levied on the imported goods in addition to the applicable custom duties. Now we'll talk about the intra-state transfer. Under section 8 of IGST Act 2017, supply of goods and services shall be treated as an intra-state supply, where the location of the supplier and the place of supply are in the same state, same union territory, same rather central goods and service tax, CGST and SGST or UTGST will be charged on the intra-state transfer. Now let's have the two examples. The state of supply is Maharashtra, place of supplier is Maharashtra. So we are going to charge CGST plus SGST of Maharashtra. The place of supply is Delhi, the place of supplier is also Delhi. So CGST and SGST of Delhi. The place of supply is Chandigarh, place of supplier is also Chandigarh. So CGST and UTGST because it is a Chandigarh. Now how to decide IGST or CGST plus SGST while raising the invoice? Location of supplier and place of supply, these are the two basic determinants to decide whether you are having IGST or CGST plus SGST. Now whenever the transaction is in the same state, we call it as an intra-state, that is CGST plus SGST. When it is in the different state, that is called as interstate, we call it as a IGST. Now let's have some example on that. Let Mr. A of Andhra Pradesh sold product Y to Mr. B of Maharashtra for 30,000. Mr. B supplies such product to Mr. C in Maharashtra for rupees 40,000. The rate of GST is 18%. Now let's have a check on the invoice which is prepared by Mr. A. See, the selling price is 30,000, but Mr. A is supplying goods to B, which is in the Maharashtra. So this is an interstate transaction from Andhra to Maharashtra. So we are going to charge their IGST straightway at 18%. So 18% of 30,000, that is 5,400. So total price becomes 35,400. Now let's have a glance on the invoice which is prepared by Mr. B. Mr. B is selling goods to Mr. C. Both are in the Maharashtra. So the supplier as well as place of supply in Maharashtra. So it is intrastate sales. And therefore, they are going to charge CGST plus SGST of Maharashtra. So CGST at 9% of 40,000, that is 3,600. SGST at 9% on 40,000, that is again 3,600. So the total becomes 47,200. Now we'll talk about the GSTM, that is Goods and Service Tax Network. It is a non-government private limited company under the Section 8 of Companies Act 2013, that is not for a profit company. Technology is a backbone for the GST in India. GST being a destination-based tax, the interstate trade of goods and services, that is IGST, would need a settlement mechanism among the state and the center. This is possible only when there is a strong IT infrastructure and a service backbone which enables capture, processing and exchange of information among the stakeholders, that is including taxpayer, state government, central government, accounting offices, banks, RBI. And as a result, the GSTN, that is Goods and Services Tax Network, has been set up. The GST network will soon become 100% government owned company, converting GSTN to government entity on September 26, 2018. Now, what is the functions of the GSTN or the role which is assigned to the GSTN? Creation of common and shared IT infrastructure for functions facing the taxpayer has been assigned to the GSTN. And those are filing of registration application, filing of return, creation of challan for the tax payment, settlement of IGST payment like clearing houses, generation of business intelligence and analytics. So all statutory functions to be performed by the tax official under GST like approval of registration, assessment, audit, appeal, enforcement will remain with the respective tax department. Now we'll talk about the registration under the GST. Students, registration is the most fundamental requirement for identification of taxpayer, ensuring the tax compliance in the economy. Without registration, a person can neither collect tax from his customers and nor claim any input tax credit of the tax paid by him. Registration of any business entity under the GST law implies obtaining a unique number from the concerned tax authorities for the purpose of collecting tax on behalf of government and to avail input tax credit for the taxes on his inward supply. The following are the advantages to the taxpayer who obtain the registration under the GST. Basically, he is a legally recognized as a supplier of goods and services or both. He is legally authorized to collect the taxes from his customer and pass on the credit of taxes paid on the goods or services supplied to the purchaser or recipient. He can claim input tax credit of taxes paid and can utilize the same for the payment of taxes due on supply of goods or services. Seamless flow of input tax credit from supplier to recipient at the national level. Registered person is eligible to apply for government bids, contracts or assignment. Registered person under GST can easily gain the trust from the customer. Now, what are the exceptions for the registration of one registration for one state? Multiple registrations permitted for separate business vertical, one as an input service distributed and other for the outward supply. Now we'll see one example. Apple manufacturers computers, tablets, phones, headphones, music player and many more. Management at Apple can divide overall company performance into the smaller segment based on these products to measure where the company is succeeding. And for this purpose, students, we are applying the accounting standard 17 of business segment. Now under section 22(1) of CGST Act, the registration is mandatory if the aggregate turnover exceeds certain limit. Now this notification is given in the 2019 and it is effective from the 1st April 2009. For the supplier engaged exclusively in supply of goods and for the states of Manipur, Mizoram, Nagaland and Tripura, the threshold limit is rupees 10 lakh. While Uttarakhand, Meghalaya, Sikkim, Arunachal Pradesh, Pondicherry and Telangana, that limit will be 20 lakhs. Now the rest of the India, the aggregate turnover should exceed 40 lakhs for the registration purpose. For the supplier engaged in supply of services or both goods and services, in the states of Manipur, Mizoram, Nagaland and Tripura, that aggregate turnover should exceed 10 lakhs, while the rest of the state of India, it is 20 lakhs. Now, what is aggregate turnover? Under section 2(6) of CGST, the aggregate value of all taxable supplies include the value of exported goods and services, exempted supplies, interstate supplies between the distinct person having the same PAN, or supply on owned account and on behalf of principal. While the aggregate turnover should exclude the inward supplied on which the recipient is required to pay the tax under the RCM, that is reverse charge mechanism. Similarly, the CGST, SGST and UTGST as well as IGST, that should be excluded from your aggregate turnover. In addition, the compensation cess is also excluded while calculating your aggregate turnover. Now let's have some case studies to find out the aggregate turnover and whether the registration is required there or not. See the case 1. Mr. Jeevan has been involved in supplying taxable material in Jammu Kashmir. His turnover exceeds the limit of rupees 40 lakhs. Is Mr. Jeevan is required to register under GST law? Yes. The taxable turnover exceeds 40 lakhs and then the supplier shall apply for the registration and therefore Mr. Jeevan is required to register under the GST law. See the case 2. Miss Chanda of Calicut is trading on her own goods and also acting as an agent of Mrs. Beena of Bangalore. Miss Chanda's turnover in the financial year 2019-20 is rupees 22 lakhs in her own account and rupees 19 lakhs on behalf of the principal. Now, whether Miss Chanda is liable to register compulsory under GST law? Student, as we have seen earlier, the provisions of aggregate turnover, both the value of supply on her own account as well as acted on behalf of a principal, we have to consider them together. And therefore, the aggregate turnover, both that is value of supply on Miss Chanda's account, that is 22 lakhs, and as she is acting as a principal, so 19 lakhs will be aggregated. Hence, the aggregate turnover will be 41 lakhs, which is more than the aggregate threshold limit. So, Ms. Chanda is liable to register compulsory under GST. Now, we will talk about the person who are not liable for the registration. Under section 23(1)(a), any person who is engaged exclusively in the business of supplies of goods and services or both, they are not liable to tax or wholly exempt from tax under CGST and IGST. Section 23(1)(b), an agriculturist to the extent of supply of produce out of cultivation of land. Section 23(2), the government may, on the recommendation of GST Council, can cancel for the registration, or the person can be exempted for not having a registration under the GST. Students, till now we have seen the basics of GST. We have seen the dual model of GST. We have seen the basics of registration, that is, to whom the registration is compulsory, as well as to whom the registration is not compulsory. Now, in the next session, we are going to have many more interesting facts about the GST. Thanks a lot, students.